On an ordinary morning in Shanghai, a quiet financial switch was flipped. It let foreign traders turn Chinese yuan directly into solid gold. No questions asked. For 50 years, Western banks trusted the world would never have this option. Now, for the first time since the end of the dollar's gold window in 1971, that trust is shattered. Why does this single feature of China's monetary system terrify the world's biggest banks? The answer begins with a flaw no one thought could be fixed. Until now. For years, the yuan carried a reputation it could not shake. The yuan was easy to acquire but nearly impossible to send back out. The reason sat at the heart of China's financial system: capital controls. These rules meant that once a foreign exporter accepted yuan, they faced a maze of regulations and unpredictable approvals to convert it into dollars or euros, or to move it out of the country. On paper, the yuan was fully convertible for buying and selling goods. In reality, capital account restrictions kept large sums locked inside China's borders. Treasury desks from the world's biggest oil producers and commodity exporters understood the risk. Accepting yuan for a tanker of crude or a shipment of copper was not just a question of exchange rates. It was a question of what could be done with those yuan after the deal closed. In practice, most foreign holders found themselves with two main options. They could buy more Chinese goods or invest in Chinese government bonds. Both choices tied their fortunes to the policies of the Chinese Communist Party. If Beijing changed the rules, tightening controls, freezing accounts, or shifting regulations, exporters had little recourse. Trapped currency. This dynamic shaped the global oil market. For decades, Saudi Arabia and other Gulf states preferred dollars, not just out of habit, but because dollars could be recycled into U.S. treasuries, global assets, or any currency in the world with no questions asked. The yuan, by contrast, was seen as a closed loop, a trapped currency. Even as China's share of global trade soared and its central bank promoted the yuan for cross-border settlement, trust barriers held firm. Financial analysts and market observers pointed to this flaw again and again. The risk was not theoretical. It was written into the rules of China's currency regime, and exporters knew it. Without a credible exit, the yuan remained a token that could not escape the system that issued it. Until that changed, no amount of trade volume could turn the yuan into a true global alternative. A trade deal closes in Shanghai. An oil producer receives yuan for a tanker of crude. Instead of holding the currency and facing the old maze of capital controls, the exporter turns to the Shanghai Gold Exchange. Here, a clearing member initiates a delivery versus payment transaction called DVP. This mechanism ensures that the transfer of yuan and the release of physical gold happen at the exact same moment, and neither side bears settlement risk. The exporter's account is credited with gold bullion, stored in a designated vault operated by an SGE-approved custodian. These vaults are often located in Shanghai Free Trade Zones or in Hong Kong, and they are managed under strict protocols. Serial numbers are tracked, security systems are in place, and insurance policies cover every ounce. The exporter does not need to wait for Chinese regulators to approve a capital outflow. The gold is already theirs, title transferred on the SGE books the moment the yuan clears. Next, the exporter arranges logistics. Specialized carriers, firms like Malka Amit or BRICS, coordinate with the vault operator. Insurance is recalculated, paperwork is filed, and customs declarations are prepared. The physical handover follows a tightly scripted routine. Gold bars are weighed, sealed, and loaded under armed guard. Industry standards dictate that from the moment a withdrawal is requested, physical release from vault to outbound transport typically takes 1 to 3 business days. The entire chain is designed for speed and certainty, not fantasy. Instant shipment is impossible, but electronic settlement is nearly immediate. For the exporter, the yuan is just a temporary token, a bridge between oil and gold. Within hours, sometimes the next business day, the gold can be on a plane bound for Riyadh, Tehran, or Moscow. The exporter bypasses the dollar, sidesteps Chinese capital controls, and takes delivery of a universally trusted asset. The system's real power lies in its reliability. Every step, clearing, vaulting, insuring, and transporting runs on established protocols, not political discretion. The Shanghai Gold Exchange provides the operational backbone, but it is the seamless handoff between clearing members, vault operators, and logistics firms that makes the golden loop more than theory. This infrastructure answers the old trust problem with a practical, step-by-step exit from the yuan, measured in hours and days, not years, or regulatory cycles. China's gold accumulation over the past 15 years has no parallel. Officially, the People's Bank of China reports reserves just above 2,300 tons. Yet independent analysts drawing from customs data, refinery output, and unexplained import surges estimate China's true holdings could exceed 5,000 tons, with some projecting as high as 6,500 tons. This gap is not an accident. Beijing keeps its real numbers close, using state banks and offshore intermediaries to buy quietly, avoiding market disruption and preserving strategic ambiguity. What goes into China almost never leaves. Since 2008, China has been the world's top gold producer and importer, with annual imports sometimes topping 2,000 tons. Every ounce is routed through domestic vaults or free trade zones, locked down and off the global market. This war chest is more than a defensive asset. On the Shanghai Gold Exchange, physical gold settles by delivery versus payment, not by promises or paper. In 2023, the SGE processed over 17 million kilograms in trading volume, with more than 1,600 tons withdrawn for physical settlement. The infrastructure is built for scale: vaults in Shanghai and Hong Kong, refinery partnerships, and a logistics network that can move bullion across borders. Contrast this with the Western system, where gold is mostly traded as paper claims. In London and New York, futures contracts and unallocated accounts mean the same ounce can be sold and resold 100 times. The leverage is staggering. Some estimates put the ratio at 100 to 1, paper gold to physical. As Chinese and other Asian buyers demand delivery, this leverage becomes a liability. Vaults in the West have seen steady outflows to satisfy Eastern settlement. Each physical withdrawal tightens the squeeze, exposing the gap between what is promised and what is deliverable. China's capacity to absorb gold through official channels and opaque networks means that physical outflows can continue for years, not just months. The war chest is deep enough to support a sustained drain from Western vaults. If exporters keep converting yuan into gold and shipping it out, the pressure on paper markets will only intensify, threatening to break the system's credibility. The world's largest gold stockpile is not just a reserve, it is a lever, ready to pry open the gap between paper claims and physical reality. In August 1971, President Nixon appeared on television to announce that the United States would no longer convert dollars to gold at a fixed rate. That moment, known as the closing of the gold window, ended the Bretton Woods system and set the stage for a new era, dollar hegemony. From that point forward, the world's central banks recycled their trade surpluses into United States Treasury bonds, creating a self-reinforcing loop. Oil exporters, manufacturers, and emerging economies earned dollars through trade, then lent those dollars back to Washington by buying treasuries. This cycle kept United States interest rates low, allowed for unchecked government spending, and fueled decades of global growth, all anchored by trust in the dollar's liquidity and the depth of the treasury market. But the golden loop now threatens to unwind that privilege. When exporters convert yuan into physical gold in Shanghai, those funds no longer flow into treasuries. Central banks, once the largest buyers of United States debt, are quietly shifting their reserves. Treasury International Capital data shows China's holdings have dropped from a peak of $1.3 trillion in 2011 to under $800 billion by 2023. Japan, once neck and neck with China, is also reducing exposure. At the same time, central banks worldwide are buying gold at a pace not seen since the 1960s. According to the World Gold Council, official sector gold purchases hit a record high in 2023, with over 1,100 tons added globally. China alone reported 10 consecutive months of gold buying leading into 2024, while its reported reserves climbed above 2,300 tons, though independent analysts estimate the true figure could be double that. This is Gresham's law in action. As the world faces a choice between dollars backed by rising debt and yuan that can be exchanged for gold, central banks are spending the former and hoarding the latter. The old recycling loop that once propped up the American financial system is breaking down. Instead of lending their surpluses to the United States government, nations are building stockpiles of the one asset with no counterparty risk. For the first time since 1971, the foundation of global finance is shifting from paper promises back to tangible reserves. The stakes are no longer limited to markets or commodity flows. They now reach into the heart of sovereign finance, threatening the very mechanism that has sustained the dollar's dominance for half a century. Today, physical gold quietly crosses continents, while global debt balloons. As central banks shift reserves from paper promises to tangible assets, the foundation of modern finance is being rewritten in real time. The world's next monetary order is not waiting. It is already in motion. What side of history will you stand on?